So you want to make money with investing, but you have no idea how to start. You're at the beginning of your investing journey, have insufficient knowledge, and have the fear that you lose the money rather than growing it. You could invest into bonds, stocks, crypto, property, or you could even swing trade or day trade, or you could invest into something more exotic, like, for example, foreign exchange or commodities. But what is the best and safest way to start as a beginner with little money? This is what we will cover in this video. The first thing to clarify is the difference between trading and investing, as this is usually causing a lot of confusion for beginners. Investing is more like a long-term game. It's like planting a tree and nurturing it to produce some fruits. Whereas trading is more a short-term game. It's like going to a market and buying and selling fruits based on the current market fluctuations. So trading is more active. It's like having a part or a full-time job, whereas investing is more passive. However, investors could choose to take more action also in investing if they deem necessary. Traders usually use technical analysis, so the candlestick bar charts and short-term news events to make their trades, whereas investors are more concerned with fundamental analysis, so the financial numbers of the assets they invest in and the surrounding environment. So what should you choose as a beginner? Well, I have tried both and can give you a straight answer on that. It's investing. The reason being is that trading requires a large learning curve and you will have to compete with professional investors, which many times have insider knowledge that you don't have. So to build up the knowledge and become a successful trader will take several years. Just to make it clear, I'm not suggesting that you should never trade. I'm only saying it's not the right way to start as a beginner. It's like trying to fly an airplane with a driver's license. You might get the airplane into the air, but a crash is almost guaranteed when you don't know what you are doing. The knowledge that you will acquire with investing will also help you if you decide later that you want to go down the trading route. Therefore, from here on out, we will focus on investing only. Investing in itself is a really huge topic. You can invest into bonds, stocks, crypto, real estate, and so on. But how do you actually make money with investing? Let's take a look at a few options. When you buy bonds, for example, you lend money to the government or a company and you will get interest payments over the time you lend this money to them. So it's basically like getting regular rental payments for the time you rent out your money. When you buy property, you buy land and build a house on it, or you buy a finished house or a finished flat. You can then rent out the property, which will give you income in form of rental payments. And if you are lucky, over the long term, the price of land will increase, which means you might be able to sell your property for a higher price. When you buy stocks, you basically buy shares of a company. If the company can increase their sales, then the stock price usually goes up. And many times companies also pay dividends, which is basically a share of their profits to investors on a yearly basis. When you buy crypto, then you basically buy a coin like, for example, Bitcoin, and will hope that the price will go up over time. You might have noticed the difference between crypto and the other options such as bonds, stocks, and property. When we invest into crypto, we do not get interest payment, we do not get rental income, and we do not get dividends. So we do not get regular payments like for the other investment options. And this can become pretty important when it comes to a concept we use in investing called compounding. You can think about compounding like rolling a snowball down a snowy hill. It starts small, but as it rolls, it will pick up more snow, getting bigger and bigger. Similarly, with compound interest, your investment earns interest, and that interest will earn more interest. Let's say you invest $1,000 into an investment that returns an average of 9% per year. So after the first year, you will get the profit of $90. But in the next year, you will not get the 9% on the $1,000. You will get the 9% on the $1,090. This is the power of compounding. So over time, your investment will grow faster and faster and faster and faster. But, and there's always a but, there is of course an enemy. The enemy is called inflation. What is inflation? It's when prices rise over time. So why do prices rise over time? This can stem from various factors such as economic events like supply chain disruptions, more demand than there is supply, or simply because business owners want to increase their profits and know they can. So by how much does inflation rise year on year? This will depend on the country. In the US, for example, the inflation rate was around 2.5% over the last 20 years. And in Singapore, where I live, the inflation rate was around 1.8% per year. Now, if we take an annual average inflation rate of around 2%, what this means is that a service that was costing you $100 20 years ago will now cost you $150. So 50% more than 20 years ago. So if business owners raise prices, how can we combat that? One good idea, for example, would be to own a business. Now you say, of course, whoa, I don't have the money to make a business and I don't have the knowledge to make a business. I have no chance of opening a business right now. So the simple answer to that concern is just buy into somebody else's business. How can you do that? By buying stocks, so shares of another person's company. If you think about this, you might raise some valid concerns. Well, investing into a business is pretty risky. What is if this business goes bankrupt? One way would be to just buy a business that hardly will go bankrupt, such as, for example, Apple or Google or another big business that is well established in the market. But is there a guarantee that such a business won't go bankrupt? No, there isn't. So what could we do to limit this risk? Well, we could buy several companies. We could, for example, buy shares of 500 companies. If one company or two companies go bankrupt, we will hardly feel it. But there is, of course, a catch to this method, as it will be pretty expensive. If one stock is costing $100, then 500 stocks will cost $50,000. And this is money we might not have or not want to invest as a beginner. Thankfully, there is a solution for this too. It's another investment option, which is called a fund. What is a fund? A fund is basically a basket of securities like stocks, bonds, or other securities, which you can buy for one single price. The fund company in the background ensures that sufficient full shares are bought of each stock to satisfy all the shareholders' ownership. There are several different types of funds available. The two which are the most important for long-term investors are mutual funds or exchange-traded funds. A mutual fund is an actively managed fund, which means it has a fund manager and a team behind him which will analyze stocks and exchange stocks based on what they think will bring the highest profit. An exchange-traded fund, on the other hand, is passively managed and usually tracks an index, such as, for example, the S&P 500 or a world stock index. These funds are put together once and will then just track the market index. So you will get the return of the market. You will not be able to outperform the market. So the benefit of a mutual fund is that you have professional management, but that professional management will come with a price. And it's not guaranteed that the fund manager will actually be able to outperform the general market. Whereas an exchange-traded fund will not be actively managed, but therefore has much lower cost than the actively managed one. So the active management of the mutual fund will cost you around 1 to 3 3% per year of the money you have invested. Whereas with a passively managed fund, costs can be as low as 0.02% or a little bit higher. A mutual fund can usually only be traded at the end of each business day, whereas exchange-traded fund can be traded like a stock on the stock exchange during the market hours. So as there is no guarantee that an actively managed fund will actually beat a passively managed fund, many people decide to go for the passively managed fund because of the lower costs. Exchange-traded funds that track the S&P 500, for example, have historically returned around 8 to 9% per year. So how much is the cost of such a fund? And that will vary depending on the fund. The ticker symbol VOO, which tracks the Vanguard S&P 500 ETF, for example, is costing you around $550 per share. And VT, which is a Vanguard Full World ETF, will cost around $120 at this time. Now, this can still be a little bit expensive if you are a beginner and just want to dip your toes in the water, or if you are a student that simply doesn't have that money yet to invest. The good thing is that some brokers now offer a solution for that, which is called fractional shares. With fractional shares, you don't need to buy a full share. You can buy a share based on a dollar amount. You could, for example, buy VOO, which is the Vanguard S&P 500 index, for $10. So this way you can start investing with a really small amount and limit your risk. Now, one thing we didn't take into consideration yet, what is if the broker goes bankrupt? For sure, we will lose all our money. This is not necessarily true. If you have a good broker that is regulated by the monetary authority in your country, then the chance is high that the broker is keeping your assets separate to his own. This means that if the broker goes bankrupt, your assets still belong to you and you can transfer them to another broker. How can you check if this is the case? Well, you could ask the broker if this is stated in the contract and search the clauses in there, or you could ask the broker if they can give you a document where this is clearly stated. Now, the next question to answer is, which fund should you actually choose? There are tons of funds out there, so which ones are best suited for beginners? While this can be a difficult question to answer, one option is that you just go with a world ETF, so an ETF that has a lot of exposure to different kind of stocks around the world. Or you could go with the S&P 500, which is an index that tracks the 500 largest companies in the US, of which many of them are also international players. So also there you will have a certain amount of currency risk and diversification into different countries. These are two types of funds which are usually quite well suited for beginners. Now, there are different fund companies that offer ETFs that track the S&P 500 or a full world index, such as, for example, Vanguard, Fidelity, or BlackRock. Vanguard usually has really good prices, Fidelity as well, so just look into the prices and then choose the one that suits you. The next question we need to answer is when to actually buy the fund, because sometimes the stock price is pretty high, sometimes it falls, but it could fall further. So many people get paralyzed and never actually buy because they think, oh, now the stock price is too low, or oh, now the stock price is too high, which keeps them basically from investing. The good thing is there is a strategy that we can use, which is called dollar cost averaging. With dollar cost averaging, we basically buy the same amount each month. So in some months we will buy higher, in some months we will buy lower. Over time it will average out, and we do not have to be concerned anymore as we just buy on a monthly basis, regardless if the price is high or if the price is low. I hope by now most of the things make sense. But you might still be asking, is it really worth my time and effort? The good thing about long-term investing is that you really don't have to spend much time. You just put money in once a month and that's it. And that can be automated with automated payments. And to your question, if it's really worth the effort, let's take a look at a few examples. Let's say you decide to invest in the S&P 500, which returns around 9% per year on average. Let's deduct the inflation, which is 2% on average, which gives us a profit of 7% on average per year. Let's take a look at a few examples. Let's say we invest $10 only once over the time frame of 30 years with a 7% interest rate compounded annually. So you only plunk in $10, then you leave it, that's it. How much would we get after the 30 years? As you can see, we will get $76. Now, this doesn't seem like much, but basically we have made 7 times more than we have put in without lifting a single finger after that. So, not too bad. But let's see another example. Let's say we put in $1,000. And we will keep all the rest the same. This will give us $7,000. Now let's say we put in $10,000. This will give us $76,122. But let's say we want a dollar cost average, so we want to put in the same amount every month. So let's look what happens if we put in $100. So let's put in $100 as the initial investment sum. And then for the monthly contributions, we also put in $100. We keep the 30 years and we keep the interest rate of 7%. So let's calculate this. And this looks pretty good already, right? So we will get $114,114 over 30 years. But what is if we actually want to become a millionaire? So how much would we need to put in to become a millionaire after 30 years? Let's try with $1,000. So we will put in $1,000 as the initial investment. And we will put in $1,000 for the monthly contributions. So let's calculate this. And as you can see, this would then yield $1,141,000. So what this shows us is that if we can invest consistently, we are able to increase our wealth quite a lot. An additional question you might have is, when do you actually sell? This will depend on your investing reason. If you have set yourself a specific financial target, then of course you might withdraw the money once you have reached that financial targets. But many people that are investing for the long term invest for retirement. And so they will usually only pull out some of the money once they are retired. There is a guideline called the 4% rule, which suggests that retirees can safely withdraw up to 4% of their investment for retirement savings each year, adjusted for inflation, without significantly risking running out of money. So that basically means that you can keep your investment over the full lifetime and only withdraw a part of it on a yearly basis to cover your retirement costs. Another point I want to mention is that everybody has a different and unique financial situation. Maybe you have loved ones to take care about, or you are heavily in debt. If you are in debt or have loved ones to take care about, it always makes sense to speak with an independent financial advisor to ensure that your investments are aligned with these circumstances. And now that the topic is on financial advisors, I would also like to speak quickly about conflicts of interest. If you talk to a financial advisor that is directly employed by a bank or an insurer or another financial institution, then there can be some conflict of interest. The reason is that financial advisors employed by financial institutions usually need to sell the products these companies offer. This could mean that they might have to balance the interests of their financial institution and yours, which might then not lead to the best advice because they need to sell something that is profitable to them too. That's why it's usually better to go with an independent financial advisor that is paid by you directly and is not employed by any financial institution, nor does he get kickback fees by those financial institutions for the products that he advises you to buy. If you do not have this luxury and you talk to a financial advisor that is employed by a financial institution, first think about what you want and then always ask yourself, what incentive does the financial advisor have to sell me the product that he wants to sell me? Another advice I'd like to give you is that there are so-called structured products out there, some of which demanding that you have to pay in for a certain amount of years before you see any return. Under regular circumstances, I would not advise to buy such products, as when you lose your job or you have issues with money, this can be an additional burden. And if you are not able to pay your rates on time, you will incur penalty costs, and you will also incur heavy penalty costs if you need to withdraw from the contract. That's why it's usually better to keep your investing simple and either go for an exchange-traded fund or a mutual fund where you do not have to lock yourself in or pay any money up front for several years before you see a return. The good thing about mutual funds and exchange-traded funds is that you can pull your money out at any time when you need it. So to recap, choose a good fund, one that, for example, tracks the S&P 500 or one that tracks a world index. Make sure that you choose a safe and financially regulated financial institution such as broker or bank. Make sure that your assets are kept separate from your brokers or your banks so that the ownership is very clear. Don't try to time the market and use dollar cost averaging. And if you don't have much money, then make use of fractional shares. But if this is not your thing and you need help, then you could go with a normal, regular mutual fund from a bank, for example. I do hope that this video has delivered on giving you a better understanding of how to invest as a beginner. Another video you might like will pop up here or here. Have a good one and see you in the next video.